All right, so today we're going to be talking about the secret of account protection and growth. Now, I'll warn you, a lot of these concepts are going to be new to many of you, and they're going to be foreign, and you might get your back up a little bit when you hear some of the things I'm going to present to you today. But I encourage you to keep an open mind. Don't just dismiss them out of hand because they may be contrary to things that you've been told before. Remember that if what you've been told about trading and money management so far were true, then you'd all likely be very successful traders already. All right, so let's get started. Have you ever wondered how Wall Street trades? Sure, there have been disasters in the financial markets in the past, but those were almost all related to bad mortgage practices, not trading. Fact of the matter is that trading is huge revenue for banks and investment firms. It was reported that last year top traders on Wall Street earned nearly $80 billion in profits. That's just off of the trading floor. That's not other investments. That's not, mortgages and all these funds and such that they're running. This is money that they took in off of the trading floor. In fact, the Bank of America recorded a $5.6 billion in trading revenue. So how do they do it? Do you think that they trade like you do? Probably not. I know you're thinking that they have millions at their disposal and it takes money to make money, and that's partly right. But that's not the real answer for their success. Their success has more to do with money management. It's how they manage their funds rather than the amount of their funds. The good news is that this is something that you can do as well. You can learn to manage your funds just like the most successful traders on Wall Street. These are not principles that are going to be unique to them. These are things that you can do. You can share in their success. We're going to look at some of the common trader practices and why these could be holding you back from being the successful trader that you really want to be. All right, so myth number one. Myth number one says that you need to have at least a 2-to-1 or 3-to-1 reward to risk ratio before you take a trade. That, I'm afraid to tell you, is wrong. In fact, I think it's the biggest lie ever told to traders. On the surface, it seems to make sense, right? You want to earn more than you're risking. But have you ever tried to do it? Now listen, I used to be on the same soapbox telling traders that they needed to have at least a 2-to-1 or 3-to-1 reward to risk before taking the trade until I actually tried to do it and found out for myself that it doesn't work. Why doesn't it work? Because you don't know the reward side of the equation. That's why. It seems simple, but traders continue to ignore it. I get into some traders get rather heated at me on my views of risk-reward ratios, but why would you take or pass on a trade on a part of the equation that you don't know? Here's a couple of charts, just for example purposes. And I purposely deleted the market because this could be any market, but on the left, we have a trade that has about a 1-to-1 reward to risk. The market on the right, which is risking about the same amount of money, barely has a 1/2-to-1, probably about a 1/3-to-1 reward to risk. Which trade would you take? Would you take either trade? Would you pass on both? Well, most traders tell me that they'd probably take the trade on the left because at least it has a 1-to-1. What if I told you the trade on the left turned shortly after breaking that area of support and continued higher only to stop you out whereas the trade on the right went 5 times the risk amount in profit. You see, you never know. In fact, I could tell you that both markets fell off the map or both tanked. You don't know. How many times have you passed on a trade because you couldn't see the potential reward, only to watch the market move much further than you ever expected, and much further without you, obviously, because you passed? Or how many times have you seen a good potential reward on the trade and only to have the market come up well short or turn your position into a losing position? If you're honest, it's probably more often than you care to count. For the most part, Wall Street traders ignore risk-reward ratios. They're not oblivious to the concept. They know they need to earn more than they lose. They just don't take or pass on a trade if the ratio is off. They're more interested in probabilities. What is the probability of this trade working out versus is it going to have enough reward relative to my risk? You see, the whole myth of the risk-reward ratio came about because of low probability signals. That meant that you had to take trades with higher profit potential, or at least perceived higher profit potential, because what is the potential profitability of a trade? No one knows. It could be the move of the year or it could be a minor trickle. The fact is nobody knows where the market is going next. Nobody. And honestly, if anyone tells you they know where the market is going next, they are flat out lying in their teeth, because nobody knows. Yes, we can all make our best guesses, and sometimes the market will make us look like rock stars, and other times it'll make us look like complete idiots, because nobody knows. But there are some setups that have higher probabilities than others. And if you've been trading for any time at all, no doubt you've come across some of these setups. So what is a trader to do? What should you do? Quite simply, if you can afford the risk, you take the trade. That sums up the entirety of a trade you should take and a trade you should pass on. If you can afford the risk, you take the trade. Why? Because the risk side of the equation is all that you have control over. That is the only part of the risk-reward equation that you have absolutely any control over. And controlling your risk is what will make or break you as a trader. Let me repeat that because this is so important. Controlling your risk is what will make or break you as a trader. Therefore, your success is directly tied to how well you manage your risk. So how do you manage your risk? Well, there's two ways to manage your risk. First off, you need to expect the worst. And second, you should never risk more than you can afford to lose. Many years ago, there was a trader, he called himself the Phantom of the Pits. Only a few people knew his real name, but he was a floor trader, and he had some really good advice for traders. One piece of advice that he gave has always stuck with me, and it was he called Phantom's Rule Number 1. And Rule Number 1 says that in every position, you should assume you are wrong until the market proves you right. Why? Because assuming you are wrong makes you more sensitive to realizing a loss. And the ability to take a loss is a very valuable quality for a trader to have. Paul Tudor Jones, one of the most successful traders of recent times, says that if 99% of traders focused on their risk rather than the pie-in-the-sky reward, they would all be very successful traders. And yet, what do we have a tendency to do as traders? We're all focused on how much money we can make. We are always ignoring how much we can lose. Do these men know more about where price will go than you do? No, of course not. But they do know how to control their risk. So expect the worst. Don't be afraid to take a loss. Losses are a part of trading. It doesn't make you a bad person to take a loss. That's part one. Part two of the equation is learning to never risk more than you can afford to lose. And this is a concept that a lot of traders have difficulty with. Most traders think that they're smart if they limit their risk exposure to 1, 2, or 3 contracts. They say if I keep my position size small, then I'm going to avoid wiping myself out. But they fail to consider how much the trade will actually cost. In fact, a single contract trade can be more expensive than a 5-contract trade if it isn't done right. The key to controlling your risk, and this is so important, the key to controlling your risk is only to trade a certain percentage of your account. Professional traders and money managers agree that you shouldn't trade more than 5% of your trading capital. You should never risk more than 5% of your capital on a trade, and 2% is considered the ideal position size. The reason is simple. They know that there's a very real statistical probability that they could take as many as 10 losing trades in a row. So by limiting your risk to between 2 and 5% of your account, you're essentially limiting your maximum drawdown to about 20 to 50% of your account. Now, yes, that's a stinger. You know, nobody wants to say, "Hi, honey, I'm home." You know, I just blew out 20% of my account today. Nobody wants to say that, but the fact of the matter is, if you control your risk in that fashion, you're going to survive to trade another day. We're going to take a look here at what the average trader does and what I bet a lot of you are doing and how this is detrimental to the health of your account. So let's do an example here. Let's say you're trading a $25,000 account and you're going to risk 2% of your account. So $500 is going to be your maximum risk position. Now I realize smaller account traders are going to have to risk a higher proportion. For instance, if you're trading a $5,000 account, risking 2% is probably not feasible. You're probably going to be risking 4, maybe 5%, but it is important to cap the risk. You don't want to risk more than 5% because, like I already mentioned, there's a distinct possibility that you could take 10 losing trades in a row. And of course, if you're trading a larger account, well, the opposite is true. You can probably afford to risk less. I know a trader, he's trading a $300,000 account. He routinely risks only 0.25% of his account because he can still get adequate position size with that small of a position. But the secret is to keep your risk size the same while adjusting the position size to suit. This is of paramount importance. You got to wrap your head around this one. Your risk dollar amount never changes. Your position size changes to suit. All right, let's take an example, and hopefully it'll help make it clearer to you. So let's take a look at 3 scenarios. We're going to have a scenario 1 where the risk amount is going to be $100. So from entry to exit, the trade is going to cost $100. Well, we've already determined that with our $25,000 account, by risking 2%, we can afford $500, in which case we can afford to trade 5 contracts. If the risk amount, say, is $250 from entry to exit, well, then we can only afford to take 2 contracts. And if the risk amount is, say, $600 from entry to exit, well, then we pass on the trade because we can't afford it. We can only afford $500. That's our maximum risk exposure. Well, let's take a look at what the average trader does. The average trader says, well, let's say the average trader says he's going to trade 3 contracts on every trade. And I run into people all the time who do this. So let's say in trade number one, where the risk is $100, he is only risking $300. All right, so you say, all right, well, if the trade goes poorly, he actually fared better than we did because we risk $500. Remember, we risk $500. He's only risking $300. All right, but what happens if the trade goes in our favor? What happens if the trade actually works out? Let's say it's just an average trade. Let's say it's like a $300 winner. All right, so the average trader here, he's going to have a $900 profit, right? He's got 3 contracts at $300, that's $900. We have a $1,500 profit. We have 5 contracts at $300, that's $1,500. We have earned 60% more than he has. But even if the trade had gone poorly, we still did not lose any more money than we could afford. Yes, we lost a little bit more than the average trader did here. We lost 500, he lost 300, but we could afford the $500 loss. But the other side of the coin is what is really the most important. We are earning $1,500 where he is only earning $900. Let's dial this down a little bit more. Let's say the average trader is only taking 2 contracts. He's being ultra conservative. He's taken 2 contracts. All right, he has earned $600. $300 winner times 2 contracts, $600. We have earned $1,500, and we have not risked any more money than we could afford to lose. This is what is going to make the difference in your trading. Not only do you need to minimize or control your risk exposure, but you need to be able to capitalize on those profits when they come your way. All right, before I beat that one to death, let's take a look at the next one. All right, so let's go to scenario number 2. $250 risk, right? The average trader, he's trading his 3 lot, he's in for $750, but he can only afford 500. So right away, he is risking another 50% more than he can afford. Let's say we suck up 5 losers in a row. All right, so we've lost, oh, well, let's do 10. 10 is easier math. So we've got 10 losers in a row, $500, we've lost $5,000. So our $20,000 account is now sitting at our $25,000 account is now sitting at $20,000. Well, Joe Average Trader, he has just lost $7,500. So he's sitting now, his $25,000 account has dwindled down to $17,500. Let's say we hit another bad streak and we take another 10 losing trades in a row. And just for easy math, we'll say we lost another $5,000. It's actually, because it's a percentage, we would lose less, but for easy math, now we're down to $15,000, and Joe Average Trader has just sucked up another $7,500 loss. He's done to about $10,000 on his account. So whereas he has greater than a 50% drawdown on his account already, we haven't even hit a 50% drawdown on our account. That is how you preserve your capital, folks. Now let's take a look at the $600 scenario, the last one. We would pass on that trade entirely because it's far more than we could afford. But Joe Average Trader, he pushes himself into the trade. He takes his 3 lot. If that trade goes poorly on him, he has just lost $1,800. How long do you think you can continue to trade like that before you blow up your account? Obviously, it's a rhetorical question. So I'll say it again. The key to controlling your risk exposure for every trade is to only risk a certain percentage of your account. You adjust your position size while maintaining the risk exposure. Now, we actually have a nifty little tool called the Trade Manager that does all these calculations for you. It does it all automatically, all with the click of a mouse, right on your Ninja chart. It optimizes your position, so you're never risking more than you can afford. You can set your risk exposure right from the beginning. It always maximizes your profit potential. It has the ability to set profit targets. It has 16 different stop strategies. There's all kinds of great stuff involved in it. This isn't a promotion for Trade Manager, but I wanted to mention it to you because it is well worth your while to investigate this particular piece of software. It will pay for itself practically in the first couple of trades. All right, let's take a look at the second myth that traders are fed all the time, is that you need to take a lot of trades to make the big money. Now, I've seen a lot of traders trade. A lot of them can't wait to trade. You know, they hover waiting for the next trade, and if a signal doesn't come along quickly enough, well, they'll take a trade out of boredom or out of fear that they're missing a potential move. In fact, I had a student who lost $90,000 the year before he came to see me by trading this way. How many trades do you think you need to take per day to be a successful trader? How many trades do you think Wall Street traders take every day? It's probably a lot less than you think. Most traders think they need to place a lot of trades to be successful, but that's just not true. What if I told you you only needed to take 2 to 4 trades a day? That's it. 2 to 4 trades a day, and these don't even need to be home run trades. These can just be your average trades. Let's use the E-mini S&P as an example. If you traded 25 contracts in the E-mini S&P and netted just 2 points a day, that's just 8 ticks, you will make over $500,000 a year. Now, I know you're saying, Eric, I can't afford to trade 25 contracts. All right, I understand. But even an average trader should be able to trade 3 to 5 contracts. That's still $60,000 to $100,000 a year, and all for only 2 points. Essentially, 1 or 2 trades. Just as a side note, if you were trading 100 contracts and netted 4 points, essentially 4 trades, netted 16 ticks out of the E-mini, that's $5 million a year. And don't think for a moment that there aren't traders doing exactly that. The point is, you don't need to overtrade. Overtrading kills. Here's my own personal experience. And a pretty good example of putting money management and trade frequency together. In my scalp trades, I have a $50 profit target. In most cases, I can afford to take 3 contracts. So that's $150 in profit if the trade works out. If I take 2 trades a day, that's $300 profit. 3 trades, $450, 4 trades, $600 a day. And believe me, there are people with jobs working a lot harder than that to earn far less. If I can take 4 profitable trades a day, that's $12,000 a month or $144,000 a year, approximately. Some days the markets will offer more and others, well, they'll offer less, but if I'm only looking for 4 trades a day, I can afford to be choosy. I don't have to rush off and take an iffy trade just because I'm afraid I won't take enough trades to make money. And it's also a sliding scale. You know, the more trades you take, the greater the chance that you're finally going to take a losing trade. So if you get picky, if you realize that you only need to take 4 trades a day to make a very good living, then you can be on the alert for the better signals. A lot of people sit there thinking that they have to have the courage to take the risk in order to make money. You know, you try to push beyond the fear, you try to pump yourself up, but all that does is lead you into losing money because you're forcing yourself to take a less than desirable signal. but you don't need to take a lot of signals. As I've just shown you, you can get by on 2 to 4 trades. Wall Street doesn't take a lot of signals. They wait for the quality signals, and so should you. Trading successfully takes more brains and less guts. Don't feel like you have to take a trade if your gut is telling you not to. That's not being brave, that's being naive. You know, be smart about your trading. It's your money. Like they say, nobody cares about your money just like you do. All right, so how do you do this? Well, here's my recommendation. I recommend that you start with a goal of netting $50 per day per contract. If you can make $50 a day per contract, you can earn as much money as you ever wanted. Seriously. After being able to hit this target, this $50 target, it just becomes a numbers game, just like I showed you with the example of the E-mini S&P. It's not a game of adding more trades and getting more signals, but of adding as many contracts as you can afford to trade. That is the secret, folks. Stop trying to find the next signal. You know, people get so hung up on trying to find another signal, another signal, another signal. I knew a guy who was trading a 30-second chart because he was afraid he wasn't getting enough signals. The guy was so jacked on coffee and cigarettes, he nearly gave himself a heart attack. Don't be like that. You know, you don't need to take 100 trades a day. And there's scalpers out there all the time. I come across them all the time. They think that if they're not in and out of the trades or in and out of the market every minute or two, they're missing something and their system is no good. That's not trading. So you saw from the other examples that to make the big money, it's about taking multiple contracts, all that you can afford. That's how the pros do it. And if you're going to be successful, that's how you need to do it as well. I have never ever met a successful trader who wasn't able to control their risk exposure. Learning this one skill will literally make or break you as a trader. All right, let's go on to the last myth about trading, and it's to cut your losses short and let your profits run. Great advice. Too bad no one ever tells you how to do it correctly. The average trader hears this advice and he thinks, oh, I've got to keep my stops as tight as possible, right? So you manufacture an overly tight trade, one that's going to try to yield you a 2-to-1 or 3-to-1 reward to risk. But little does he know that all he's doing is strangling his trade and very likely setting himself up for a loss in the process. Have you ever had the market run your stops and then turn on a dime and go to your profit target or well past your profit target? Ever feel like the market is running your stops? Ever wonder why? It's because it is. You know, it's no secret where the support and the resistance levels are in the market. It's no secret where traders have their stops. Part of the problem is that most traders don't know what a stop loss is for. They think it's to get them out of a trade. But the true purpose of a stop loss order is to get you out of a trade that isn't behaving as expected. And there's a world of difference between the two. The stop loss order is the point where you should say, Uncle, I've had enough. Time to cancel the trade. The stop loss is not there to minimize your risk. You control your risk before you ever take the trade, remember? Think of your stop loss risk like the ante in a card game. The ante is what you have to pay to play. A stop loss is very similar. It is the amount that you are willing to bet in order to trade. Can you take your ante back in a card game if you don't like your cards? Just try it and see what your playing partners will say. Trading is similar. Once you place your trade, you should give it a chance of success. Therefore, when you set up your stop loss, try to give your trade a reasonable chance of succeeding. If the market retreats to your stop loss order and takes you out, well, then that's fine. Concede that you were wrong about the trade, try to figure out why, and go on to the next trade. But making your stops overly tight will not help you avoid a losing trade. In fact, most cases, it will only make it worse. You've probably all seen examples of how wider stops actually hold you in a market long enough to realize a profit. We've all been there, but very few of us have actually taken the time to figure out what those stops should be. So even if you end up taking a loss, by now you know that the loss should have been one that you could afford. So while it's unpleasant, it won't ruin you in the process because your risk amount is based on what you can afford, not on how close or how loose your stops are. Am I saying you should never adjust your stops? No, of course not. But you should have a good reason for doing so besides fear. Cutting your losses short does not refer to using ultra-tight stops. Placing your stop-loss order so tight that a trade has only the slightest chance of success isn't going to work. Rather, cutting your losses short refers to not moving your stops further and further away as the market retreats against you. You know, a while back there was a big thing about averaging down into trades, and that's a stock strategy. I certainly don't agree with it. It's not something that the average trader can afford to do, and it's usually a pretty quick way to ruin your account. But you know, the stop loss is there to protect your capital. You structure your trade at the beginning, you set your stop loss, and you should consider that money your investment. If the trade works out, great. If it doesn't work out, well, then that's what it costs you to play. Give your trades adequate elbow room, control your risk by controlling your position size, and I guarantee that you will see your earnings rise. Because that, folks, is the true secret in trading. All right, let's take a look at the other side of this equation here, which is letting your profits run. Again, great advice, but most traders haven't a clue how to do it. It's important that you have a concrete plan on how you're going to manage an open trade. Don't wing it. There are a lot of good strategies for managing your stops. I'm not married to one particular stop strategy. When I start trading on the day, I'll put a few different stop strategies on and see which one seems to fit the market best that day, and I'll go with it. But the important thing is that you pick a strategy and you work with it, that you actually have a plan. You don't panic because the market backs up on you a tick or two. Or if that's your plan, then go with that. But you need to have a plan. Like I said, you don't want to do this from the seat of your pants. And it's equally important that you do a little bit of homework here. Again, it's something that most traders never take the time to figure out. You need to figure out what's going to work best. Now, we have a nifty little tool called the Profit Finder, which allows you to tweak your system to get the most profit out of it, but you can do a rough tweak manually as well. It's really not that difficult. What you need to do is take 10 trades. Take your last 10 trades, figure out your results if you had taken profit on target, if you had trailed a stop, and compare at least 2 stop strategies. It'll take you less than an hour to do, and the results might surprise you. For example, when I was using the Profit Finder, I was able to determine that when I'm trading the mini Dow, I was getting better results by taking my profit on target than by trying to trail a stop. So sometimes letting your profit run actually means taking the profit when you have it. The important thing is that you have a plan, so in the heat of the trade, you'll know what to do. And again, I can't overemphasize this. You know, you don't want to go into a trade unprepared. You wouldn't go to work unprepared, you'd get fired. Well, you show up for a trade unprepared, somebody's going to eat your lunch. So it really is a game where preparation is key. So there you have it. 3 things that you can do to improve your trading beginning right now. You can trade just like the professionals do, just like the money managers do. The big question is now, will you do it?